So the second part of our structured product series is likely one of my favorite investments that we often recommend to our clients, and those are marathon notes. So recall that a structured product, by its name, is an investment that is structured or created around the fundamentals of an underlying security. This can be equity indexes, individual stocks, bonds, currencies, etc. So here are some of the characteristics of these marathon notes. Marathon notes are designed to enhance the return potential compared to the underlying asset. It provides certainty to outperform the underlying investment over a certain period. It's suitable for investors who wish to maximize their upside gain. But like any investment, there's opportunity costs, so let's discuss some of those. As with most structured products, the pricing is very inefficient and there's often increased price volatility prior to maturity dates. And there are also no dividends that are paid to investors within these marathon structures. So for an example, XIU, which tracks the underlying TSX60 index, which is an ETF from BlackRock, would pay a dividend to investors for carrying that security. Those dividends are part of the structured note and are not offered to investors, and then hence is an opportunity cost that needs to be considered. So let's take a close look at how these marathon notes will benefit investors throughout the term of the investment. As you can see, marathon notes are going to provide additional upside to the underlying asset, and this upside becomes more fully realized the longer that you progress throughout the term. So as you can see, earlier on in the stage of the term, the upside on the underlying asset is still above, but is minimal. As you progress to, say, the second period, you can see that across midway it starts to really accelerate and you start to see that further upside realized. And then once again at the end of the term, obviously it's going to be fully realized against that multiple. And once again, just like auto-callable notes in the previous video, there are maturity barriers that are often utilized to help reduce downside risk. So as you can see, if the underlying asset falls below the maturity barrier, you're going to have no protection of capital, just like we did in the auto-callable securities. So let's take a look at the details of an exact example that we just implemented in the third week of March for many of our clients, which allows us to capture that enhanced upside on the underlying asset. So our example was we were able to obtain 2.75 times the performance of the underlying XIU or TSX60 index. So as you can see, this will guarantee to beat the underlying index over that term. And there are virtually no advisors or professional managers that can lay that distinctive a claim to outperform markets. And that's what makes these so special. So as you can see, if we were to receive a 40% return over the 5-year period, the actual multiple at 2.75 times that return would actually provide the investor with 110% return. And in the second example, where the asset actually matures below its starting value but above the maturity barrier, you would get all your capital back in this example. What's unique though is remember the inefficiencies that we spoke about these securities earlier in the video. I'm going to show you the exact math and maybe how that's going to pertain mid-term, because it is a significant opportunity cost. As we progress through the term of the investment, you can see that the valuation in the early years when your note is in negative territory, which means that for this example, the XIU would be in negative territory from when your initial purchase date was, you are actually going to have a magnified loss, or it's going to show much worse than the actual underlying security. And that's the trade-off because of that multiple. Now realize, as you progress through the term, that's going to become closer and closer to the actual realization of that multiple. And then lastly, should the underlying security, for whatever reason, be evaluated below the maturity barrier upon maturity, you would have 1-to-1 downside. So what's unique about this security is that not only does it guarantee outperformance over a prescribed term, you are only exposed to the exact same risk below the maturity barrier that you would owning the underlying security. The only difference would be dividends. So your real opportunity cost is, should the security maintain a 0% return, which is very unlikely, it will obviously be higher or lower. But let's say that it matures rate flat. Your opportunity cost would that be that you sacrifice all of those dividends along the way. But once again, we've had experience with these types of securities. We placed an excellent trade back in 2013 on the US market, and albeit it was early in our use of these securities and we didn't quite fully appreciate how powerful they were, we were able to obtain a multiple on the US economy over that 5-year period. So by 2019, we were able to get a really strong return for our clients, which was a multiplier against the US market, which obviously did tremendously well throughout that period. So there you have it, folks. Marathon notes are probably one of the most powerful investment options you can consider. And although their pricing is not always a significant benefit throughout the business cycle, during periods such as these where you want to maximize upside and gain full recovery, they are always something that you should consider. So make sure that your advisor and your portfolio managers are at least educating you on these securities, because they can be paramount in getting the maximum recovery and return you can through the next stage of the business cycle. And stay tuned for the next video where we talk about a unique and a little more complicated structured note, but a booster note, where they're really suitable for clients wishing to maximize upside in a flat to negative market.